This is your Lead Left podcast for the week of May 19th. I'm Randy Schwimmer. Welcome back. We began our visit to Tokyo this week attending S&P's Structured Finance Seminar 2025. Along with almost 200 Japanese bankers and investors, we heard senior ratings analysts and leading CLO market participants discuss trends and outlooks for global leveraged finance, CLOs, and other securitized strategies. Our panel was entitled Private Credit, Middle Market CLOs, and Fund Finance. Private credit CLOs have seen a natural evolution. They began as balance sheet financing tools for specialty finance companies. Now they provide attractive financing within a levered fund, typically as replacement for asset-based facilities. While CLO technology has been around since the late 1990s, the structures and market have evolved considerably. Just 10 years ago, the private credit CLO market was less than $20 billion, with fewer than 10 transactions done annually, really is only 5% of the overall CLO landscape. Today, PCLOs have grown to $135 billion, or 13% of the market. So far this year, they've comprised about 18% of new issue U.S. transactions and growing as the product and market gain more acceptance. CLOs are attractive as standalone investments for equity investors seeking mid to high teen returns and consistent quarterly cash distributions. When used as financing technology in fund complexes, CLOs provide strong economics in a functioning market, better leverage, attractive durations, 4 to 5 year reinvestment periods, and predictable ratings for ramped pools of collateral. For BDCs, commingled funds, and SMAs, CLOs are typically cheaper alternatives to ramping vehicles from banks financing the assets, the former with spreads of 160 to 170 basis points and the latter low 200 basis points for comparable leverage profiles. How are managers dealing with the current environment? If you're one of the 5% of direct lenders with track records before the GFC, you learned to construct portfolios with U.S.-centric middle market borrowers in service sectors, backed by top private equity firms. This allows your portfolios to withstand various rate environments and economic cycles. Niche leading businesses with high barriers to entry and flexible cap structures can stay resilient through a downturn or shock. Interestingly, the 75% of our borrowers showed positive EBITDA growth last quarter, up from 66% in the fourth quarter. What are the differences in BSL CLOs and middle market CLO collateral and structures? Leverage, for one thing, 6 times for full capital structure or arbitrage PCLOs versus 10 times for BSL, and 3 to 4 for CLOs issued out of BDCs or private commingled funds. Supply, for another. There's simply not enough loan creation in BSL to go around. Private credit annual CLO issuances have grown from 10% of the market to about 20% as BSL CLOs amortize and more private credit managers use the technology as a financing tool or AUM generator. AAA spreads for BSL are around 140 basis points versus about 160 for PC. That differential has compressed to 25 bips versus 40 to 50 historically. Finally, CCC baskets for private credit are 17.5 versus 7.5 for BSLs. PCLOs receive underlying asset ratings primarily with credit estimates issued by rating agencies. Securitizing all things here at the Lead Left, this is Randy Schwimmer, wishing you and your families a safe and healthy week.